go ahead and start the recording now. And I'd like to get just a little bit of an idea of who's here. Okay, so what I'm going to do is poll you. Okay, I'm going to do a quick poll. I know that folks are still settling in. I just saw number 29, number 30, number 31 come in the room. All right, but let me go ahead and put up this poll right now. And great audio, very good. Thanks, guys. If you would please choose one or more. I think you can choose more than one. If I blew it again on the choices, I guess you'd have to just choose the one that you're most familiar with. No, I didn't blow it. Okay, I did make for multiple answers. Okay, so multiple answers. Okay, somebody's having audio problems. We'll try to re-log in. That's Paul. Okay, Paul. Glad to know it. Glad you're getting in and back out. Okay, so we've got about 40 seconds into that poll. 67% of the room has voted. If you haven't cast your vote, please do. This will help me to to pace the presentation and to maybe to know a little bit more about you, and so that I can serve your needs better. Okay. All right. So that's a full minute, and we had over 70% vote. 74% voted. Okay, very good. All right, so 70% of you that voted are doing stocks, 65% doing cover calls. Wow. All right, I've got a great big covered call room here today. That's marvelous. I'm excited about that because I'm going to try and dispel some of the myths that go along with that, but I'm going to also give you an alternative, okay, rather than just be critical about the about the covered call play. I'm going to show you some great alternatives. Okay. All right. 61% simple spreads, bear call, bull puts, bull call, bear put. All right. And 39% of you doing combination plays. It says nobody is doing the risky stuff. Okay. So nobody's doing ratio call spreads, which is interesting because guess what? Today I'm going to show you how to do a ratio call spread, but do it risklessly. Risklessly. I know that sounds weird. All right. And none of you are doing naked calls either. Okay. Super. Okay, so we've got a pretty savvy audience. We've got a bunch of folks that are in stocks. That means that was the number one, was stocks. And just behind the number of folks that are doing stocks is the folks that are doing cover calls also with their stocks. So marvelous. Okay, so folks, I'm going to give you a quick introduction of me. And today, I didn't warn you about this, but today I wanted to do a presentation that I've got saved that I called The Art of War. Okay, The Art of War and Trading. And we are going to be talking about something that beats the living snot out of covered calls. And we're going to be talking about how it beats the living snot out of covered calls, two different ways, and the kind of success that our RadioActive Trading crew has had versus that flawed strategy. Okay. A little later on, I'll pull you again. I'll just ask how you're doing with your trading, and maybe I'll be able to ask the cover callers how they're doing. Okay. All right. So The Art of War is a classic document from China, and it was written by a man named Sun Tzu. Okay, I've been told that that's the proper pronunciation, Sun Tzu. Okay, some folks might think it's Sun Tzu. Okay, because it's spelled S-U-N and then a new word T-Z-U. Okay, but Sun Tzu is how I've been told to pronounce it. And it's interesting because some French generals dug up this old classic, and they were using the principles that were in this Chinese classic about war, using those with more modern movements, and did very well. Okay, so here's one of those sayings: attack is the secret of defense, and defense is the planning of an attack. Okay, now I can't take credit for recognizing that the principles of business and warfare are closely aligned. My dad once made that observation, and it stuck with me. Okay, he's a retired Air Force colonel. He's a Mustang, which means that he started out enlisted and then became an officer later. And in the old Air Force, to make it to a full bird colonel without having ever been a pilot is some pretty big stuff. Okay, he was very well respected and worked in the intelligence community and had flown missions, and I don't know. I'm kind of proud of my dad. It's a big deal. The degree that he was awarded largely by night school and correspondence was an MBA, okay, Master's of Business Administration. So my dad was an example of a warrior turned businessman. And I remember looking with awe at his medals and his shadow box. You know, he had a number of, he had this, the Order of the Flying Cross, and then 2 oak leaf clusters, a real warrior. Okay. And I determined that one day I would have distinguished awards like this. Okay. But I didn't end up pursuing a military career. I did up earning over 100 first place trophies in martial arts competitions. And here's a picture of me on my way to Grand Champion. Grand Champion is when the lightweight winner, the middleweight winner, and the heavyweight first place winners fight it out for first place. And I was the middleweight, and I ended up winning. And here I'm having a little bit of fun. This is called an axe kick. It goes up and then comes back down. And at this time, I'm 46 years of age. Okay, so now I'm 48. So my opponent for the final win was 18 years younger than me. And I'm saying all this stuff to you not to brag. Well, actually, I am. I'm bragging. Okay. But hey, listen, I didn't bring you here to brag about my dad's or my achievements in combat. Okay. But what we're going to talk about is the combat aspects of trading. You're still young, Kurt, says Chris. Thank you, Chris. I brought you here to discuss your winning career in trading, and it requires a lot of the same mindset. Okay, winning in combat and winning in trading requires a lot of the same mindset, because make no mistake, business is war. Business is war, and the trading pits contain some of the bloodiest side of that war. By the way, if you haven't watched The Big Short yet, it's up for an Academy Award this year. Make that required viewing. This is such an important movie, okay, and it took such an important subject. I was trading. I was around, you know, in 2008 when all these events unfolded. But yeah, if you haven't seen this, it's a real big deal. Okay, all right, an eye opener for sure. But since we've established that trading is war, all right, let's get down to this combat strategy that can make you a winner. Now, first of all, I'm going to tell you a strategy that probably won't make you a winner. And I'm probably stepping on toes here, because 2/3 of the room told me already that you're trading covered calls. But let's just think about it for a moment, okay? What do they say that you're going to make every month with covered calls? Okay, I'm just going to wait for you to answer the question. Okay, somebody text in. What do they tell you? What do all those market gurus, these covered call trading gurus, say? What do they say you're going to make every month? It's a monthly thing. Come on, folks. I know you're with me, right? Okay, very good. So 3 to 5, 3 to 6%. I was actually told, okay, Danacar says 4%, 4% a month. Compound stock earnings claims 3 to 5%, says Robbie. And Robert says 24 to 30% a year. Okay, so these have been the claims, right? Okay, 40% says David. Okay, that must be a yearly. That, you know what? A yearly 40%, that comes from having compounded monthly 3%. Okay, if you have 3% per year, at the end of 12 months, it's not 36%, it's 40%. Okay, and at the end of 2 years, it would be 100%. Okay, how are folks doing with that? Are you doing well with that? Okay, you know what? Let me do this. Let me ask. How's that working out for you? How's that working out for you? 70% of the room told me that you're doing stocks. 65% of the room said that you know, stocks and covered calls. All right. So how's that working out? Did you pick more winners and losers and win last year? Did you pick more losers and winners and happen to lose, which is quite a bit less than 40% gain last year? Did you pick more winners and losers but still manage to lose, which is possible when you limit your upside potential, which is what a covered call does, and at the same time leave your risk in place, or most of it. Okay? All right. So, folks, this is a real eye-opener. I'm looking at actual results. You know, when I have done a variation on this poll, when I have done a variation where I say, okay, look, don't vote unless you've done covered calls for a 24-month period or longer, right? I've asked, hey, did you get the 3% per month? Because in 24 months, that's 100%. That's double. Or did you get 6% per month? Because in 24 months, that is 400% or 300%, which is quadruple what you started with. Okay. Well, this one, I didn't limit the field. I didn't limit the field to folks that have done it for 2 years, but I'm going to go ahead and close the poll now. Look at what happened. 20% say I picked more winners than losers and I managed to win. Okay, good. And then 50%, half the room, picked more losers than winners, and so you lost. Okay. And then 25% picked more winners than losers, but still managed to lose. All right. So that's 75% of the room ended up losing last year, which is quite a bit less performance than getting 40%. Right? Okay, that's what compound stock earnings and other con artists promised you. Okay, 5% though ended up in this category. Take a look at this, guys. This is possible. 5% picked more losers than winners. You picked losing trades more often than winning trades, but still managed to win. And guys, guess what? I'm in that category too. Okay, I lose more often than I win, but when I lose, it's very, very low amounts. And when I win, then I'm able to maximize it. Okay, in martial arts, in combat, and in trading, if you take care of the losers, the winners will take care of themselves, and that's such an important thing to understand. Okay, Sun Tzu, the author of the classic Art of War, said that in old time, generals would make themselves invulnerable first. They'd make themselves unapproachable. They'd make it so that they couldn't lose most of their resources. Okay, they would take the bulk of their resources and put them behind a heavy embankment. Okay, and have that well defended. And that's the idea. Okay, in other words, they would take a position that was suicide for the opposing army to directly attack. All right, by positioning themselves in a high place, for example, the enemy would have to fight uphill. Okay, or by positioning themselves in the south, the enemy would have to fight with the sun in their eyes. All right, so the best generals would do this sort of thing. They'd scout out the encampments that combine both of these, and they would take those positions and from there do their stuff. Then, when the enemy was restless, crack troops dispatched by night or in small patrols would pick off stray enemy soldiers. You've heard this in other terms. You've heard it in the terms of, the key to winning stock trading or options trading is not to hit home runs. It's to do singles and doubles, right? You've heard this, okay? Small amounts of wins. By grabbing small victories a little at a time, they'd add to their booty, their supplies, and their wins, while the enemy would go into disarray. Now, let's see how this plays out in a financial setting. Wall Street is a behemoth, okay? You don't beat the street. A direct attack on your part or mine would be suicide. They have more capital. They're positioned better. They can weather the storm, and you will wear yourself out trying to beat them by means of a direct assault, okay? So instead, what we're going to do is position ourselves, okay? You position yourself so that you cannot take a heavy loss. And now, with all that buildup, I'm going to show you what we call the 5-line setup, okay? Let me go ahead and jump out of here and go into Power Options, okay? And Power Options is the tool that I use. I'm not a Power Options employee, but it is the best platform for trading options and options combinations that's out there. What we're going to do is we're going to look at Nike stock, okay, Nike, and we're going to pick up 100 shares of that. Okay, now, before we go much further, I've got to do a disclaimer. The disclaimer is I'm not making a direct recommendation here, okay? I'm not a broker, and so it would not be legal for me to say, hey, look, you know what you need to do? You need to go buy yourself 100 shares of Nike and July 62.50 put, okay? I'm not going to make that direct recommendation, but what I am doing is showing you what's available. Okay, if you're going to trade this, oh geez, this is costs a little bit more than it would have just, I don't know, 20 minutes ago when I was checking it out. Okay, but here what we've done is we've taken the bulk of our capital and we've shorted up. We've protected it with a put option. Okay, We've taken most of what we can lose, and we've covered it up. And then this put option, this is interesting, okay? The put option, you could have, what is this, 5% protection, okay? Gosh darn it, let me see here. I've got to, there we go. Okay, 5% protection, right? Well, what you could do, and what most people do with a married put play, this is a married put play, buying stock and also a put. What most folks do is they buy a put option that's out of the money. See, Nike is trading at $60 and change, which makes a $62.50 put in the money. Okay, let's go ahead and take a look at what most folks would do. What most folks would do is they go out just a few days, right? Maybe just past an earnings announcement. The earnings announcement comes up on the 29th, okay? So let's just say they go out a week or two past that, okay? And then what they do is they'd buy a put option that's out of the money, okay? And then now how much of our capital is at risk? Well, the stock can go down a bit. Okay, there you go. Actually, I think most folks would have gone even cheaper than this. But see, the stock can go down a bit, but then there's a hard floor to where you can't lose more than just 3.1%. Okay, but what I do is completely different. What I'll do is I'll pick up a put option, clear out 5 months or more away, and there's a reason for this. Okay, there's a reason for this. We'll show you in just a second. But the setup here, risk, it says that it risks $366. Now, if you noticed just a moment ago, the other setup risked $189, right? For how long? For about 2 weeks. Well, let's say that we actually decide to only hold this for about 2 weeks. Okay, we're only going to hold this until February 12th. Okay, look at this red line. This red line is the value of the put plus the stock. Okay, if it's trading at this price or that price by February 12th. So you can see if the stock stays sideways, you're not going to lose too much. It's going to be about the same. Okay, but if you had done that with the out of the money put option, you would have lost all of the time value. You would have lost everything that you spent on the put option, and you'd have to do it again if you want to do it for another month. Okay, so what I'm doing here is I'm buying an insurance policy that's good for a long time, but I'm thinking short term. Okay, just like Swoonso would have said, if you plan to march for a long way, make it look like you're only going to go a short distance. And if you plan to go only a short distance, make it look like you're going to march a long way. And it's kind of cool. Okay, all right, good. So let's see. Where are we? Let me get back to here. That is the 5-line setup. The 5-line setup is going to show us that it's going to show us that we can keep our risk down to single-digit percents, 5.5% of our capital at risk for the next a little bit more than 5 months, actually almost 6 months. Okay, now within that position, even if you dumped all of your capital into one play, you couldn't suffer more than a minimal loss, particularly if you only held this position for about another 2 or 3 weeks before you decide to do something else with it. Okay, now for the crack troops. Okay, we're going to send in the crack troops. Now this campaign is only going to last till June, or actually I think it's July. But we're going to dispatch a special unit out to the battle, just one special unit, just one little deal, and this is called the ratio call spread. Okay, so we're going to go to the ratio call spread. Let's set that up. Okay, we're going to set up a separate play here, where what I'm doing is buying a let's see here, buying a near-term call and selling 2 near-term calls against it. What? That's going to be crazy. Okay. It's going to be crazy because nobody would do that, right? Well, some folks do. Okay. Let's do this where we're buying 1 call, selling 2 against. Buying a 60 and selling 2 against. Okay. So somehow I've got to turn off my Facebook notifications. My foreign exchange student is writing me from Italy right now. Okay, so this should be coming up. There we are. Let me submit. Okay, so what happens is we're actually going to get paid to take this position on. You see where the $30 here is a negative amount? That's a negative cost. Negative cost means you're getting paid to do this play. But another thing that we should look at is not only are we getting paid 30 cents, but later on we might get paid more. For example, let's say our stock goes to 62.50. If it goes to 62.50, right, and the 62.50 calls expire worthless, that $60 call is going to be worth something. It's going to be worth $2.50, but we've been paid to own it. Isn't that something? So we're getting paid 30 cents to open this play, and we might get paid again later on another $2.50, okay, or less. We might get paid less. Now, there's a problem with this. The problem is that these crack troops, you know, they do great things, but they also take great risks. And so this may be our fate, okay, for our unit. If we send out those crack troops and we buy one call and sell two against, the result could be that we lose a lot. And why would we lose a lot? We'd lose a lot because we'd have one call long, okay, we own this call. And we have one call short. We have two calls short here. One of those calls is going to be satisfied by this one, okay? Meaning that when we're called upon to deliver our 100 shares of Nike at 62.50, well, shoot, we've got the right to buy 100 of them for 60. Okay, so we deliver it for that difference, and that's good. Okay, but what if the other 100 shares? What if the stock actually goes to $70 a share? If the stock goes to $70 a share and we have an obligation to deliver another 100 shares at 62.50, we got to buy them at 70 to sell them at 62.50. Not a good deal. Okay. All right. So that may look to you like a suicide mission. Okay, the ratio call spread. But what makes this play interesting is that it can pay you twice. You're getting paid 30 cents on your way in. You could get paid as much as another $2.50 later on. The drawback is that if you employ these special troops without support, you're taking a grave risk. Okay, the ratio call by itself, I just showed, if the stock goes to 70, then what? If the stock goes to 70, we're asking for trouble. Okay, the loss here is nearly $500. Not cool. Not cool at all. Okay, but let's not forget, these troops are backed up by the main core, right? These troops are backed up by the main core, so they don't have any worries, okay? Let's look at the ratio call in the context of the married put trade, okay? And here's the married put trade that risks $366, right? Here is the ratio call spread, which risks an unlimited amount, right? But then when you combine them, what do you think is going to happen? What do you think is going to happen when we have both the stock and the put and the ratio call spread? Boom. Well, look at that. There's less dollar risk. There's less dollar risk. And the reason for that is if your stock goes down, guess what? Your put option is going to protect you. And the most that you possibly could lose is just a few $100s, okay? 5% is what you have at risk here of your capital, okay? On the other hand, take a look at this big peak here. What happens is while the stock is traveling between 60 and 62.50, it's gaining double. It's gaining because you own the stock, and it's also gaining because you have a bull call spread in place that you got paid to own. If you think about it, you own one long call, right? And you've got a short call against it. Now, what about this other short call? Well, that's going to bring us down, but it's going to come to a limit. It's going to come to a limit to where if your stock goes to the moon, and we don't expect it to climb from $60.50 to $70 in the next month, do we? We don't. All right, but if it did, we'd still profit. We'd be okay. But this play does best if the stock stays between 60 and 65. We're going to get paid, and we're very likely going to get paid twice. Pretty cool, guys. What do you think of this? Okay, I'm going to throw up a poll there here real quick. But first, let's discuss this. Whatever the outcome of the special units battle, the main core is going to benefit. The main core benefits no matter what. The main core is your stock, your 100 shares of stock protected by a put option. Well, if you collect 30 cents to do this play, then that's going to reduce the cost basis of the stock plus put by 30 cents. And so that's a good thing, right? What if you get paid a second time? Like I told you was very likely. If the stock closes anywhere between $60 and $65, we're actually 60 and $65.30. If the stock closes anywhere between there, we're going to get paid a second time, right? And if it goes higher than that, we're going to still profit. Okay, so whatever the outcome of the special units battle, the main core is going to profit. If they went to the utmost, well, the whole core does well. Even if they die to the last man, it's going to likely improve the state of the whole brigade, okay? So enough of the battle lingo already. I know that you're getting tired of that. All right, let's just translate that into financial terms. Watch what happens if the stock goes down. If the stock goes down, let's just do the accounting, okay? If our stock goes down in the context of our ratio call spread, okay, let's say that that thing ends up being $50 at expiration. Okay, let's take this all the way till expiration. Well, what's going to happen? Keep an eye down here. We're going to keep our 30 cents. That's it. We're just going to keep our 30 cents. Okay, what if the stock goes sideways? Well, where is it right now? $60.50. Okay, let's say that the stock's price is $60.50 by expiration. Okay, what's going to happen is, hey, we're going to keep that 30 cents that we gained by doing the play, right? And because the stock will be at $60.50, our $60 call that we've been paid to own is going to be worth 50 cents. We can cash it in. We'll make 80. Our 2 short calls are going to expire worthless. That's what happens on expiration Friday. What if the stock goes along? What if it goes to $62? Well, what will happen is we're going to make $230. Why? $30 that we got paid to own this position for in the first place. And in the case of the stock goes to $62, our $60 call is worth $2. So we make $230. So what if the stock goes all the way to 70? Ooh, well, that looks like it could be a bummer, right? We're going to lose money because our stock went up more than we expected. But wait a minute. Let's not forget we're doing this in the context of owning the stock. And if we take that price all the way to, what was it, 70 at expiration, let's see if we are losing money. Nope, looks like we're still ahead. Okay, so no matter what happens with this little battle, no matter what happens with this ratio call spread that we've put in place, we're going to better our position. We're going to better our position. Is that pretty cool? I think it's awesome, especially since, you know, in just a few months, the put option is not going to decay that much. Our put option is not going to decay that much. Why? Because we bought it clear out to July, and you know, in March there's going to be 4 months of time value left in it. Okay, kind of cool. So we just looked at what happens if the stock goes up, if it goes sideways. Even an extreme in either direction is not going to result in your main camp being ransacked. Okay, your main capital is protected behind the wall of that put option, and so you can't get hurt by more than 5%. Okay, and you're safe, at least as safe as you can be in a life or death battle, which is what trading is. Okay, now is it possible that we might be able to do this another time between now and July, or between March and July? You betcha. You bet we can. You can do this multiple times. In fact, there's more than a remote chance that you're going to capture enough booty to offset any remaining risk. Well, see, what happens is, geez, what if our stock, whoops, hang on. What if our stock goes to 62.50, right? Or let's just say $62. What happened at 62 with this play? Okay, let's find out. If it goes to 62 by expiration Friday in March, that's $230 that we're going to capture in premium. Okay, so what happens is, let's go ahead and go back over to this bad boy. We'll be with this again. We'll have a stock plus a put option, but the thing is, we'll subtract $2.30 from the cost basis. So it'll be 310 cost basis instead of 540 for that put option. Oh, looky there. What we've done is we've still got a limited upside potential, but very little that we could lose. What if we did this again? What if we captured another $2.30 by doing our ratio call spread? Why, then we would be what we call bulletproof, okay? We'd actually be in a position where our put option is paid for and we have nothing but blue skies to the upside, okay? Kind of cool. Now, MK asks, can Fidelity handle this combined trade? MK, that depends. Does Fidelity allow you to do a ratio call spread? You know, it has to do with your trading clearance, okay? And by the way, it's possible, if you don't have the trading clearance to do this, it's possible for you to do a variation on the theme. And I can go ahead and show you the variation. You ready for this? You buy 2 puts and 200 shares. Then what Fidelity is looking at is they're looking at your short calls here as covered calls against the stock. And they're looking at this long call as, well, a long call that you have the privilege to buy if you have level 2 trading clearance. Okay. Let's see what that does to the overall picture. There is a period of pronounced gain between 60 and 62.50. Oh, but look, we still have unlimited upside potential. So we're getting paid to put the play on, right? We're getting paid to put this segment, the ratio call spread, buying 1 call and selling 2 against. We're getting paid to put that on, but we're also potentially going to see unlimited upside potential. It's kind of exciting. All right, that's a good question. It's possible, even commonplace, for you to use the radioactive trading income methods to capture more premium than your put options time value. Okay, and we call that state bulletproof when there's no more downside left to your stock, but there's unlimited upside potential. That's kind of cool. We've been calling this bulletproof since 2002 when I first began blogging about this. And it wasn't until about 2008 when this captured the attention of, I had sold the idea, the blueprint, my book, The Blueprint. I had sold it with only 4 income methods. And somebody that was in the New England risk-averse traders, a fellow named Chris All, gave a little presentation to his group, and then they said, okay, Kurt, we need to have you come out. And they brought me out to MIT, and I lectured at MIT and taught about this stuff. And since then, the blueprint has been sold in 40 countries. Okay, we've always called the state bulletproof. And so let's recap, okay? First, a wise general makes himself almost impossible to attack. Let me ask you this. We already asked, how did you do? How did you do last year? How's that working out for you? And this is the answers that we got. 75% of the room lost money. 20% made money by picking winners more often. And 5% made money by really handling their finances well, because even though they lost more often than they won, they still made money because they had their losses small and their wins larger. All right, and so that is these are the wise generals. Okay, a wise general makes himself almost impossible to attack. It's by keeping your capital protected. I want you to think just real quick about what I just showed you. How would this have affected you last year if you never took any loss of greater than 2 to 5% in any trade? You know, we showed this one right here where 5.5% was the maximum loss. And in truth, that's only if you hold it all the way until July, and you make no adjustments. And both of those factors are in your control, right? You don't have to hold all the way till July. And yes, you get to do as many as 12 different income methods. We have 12 different kinds. I showed you one. I showed you income method number 5, which we nicknamed the money net, the ratio call spread. Guys, tell me what you think. Would 2 to 5% loss limit have affected your trading last year? We got a whole bunch of answers here, but not 100% yet, so I'd really like to get it. Okay, I'm going to leave that pull up for another 3 seconds, 2 seconds, 1 second, and close. Okay, all right, so 10% of you that answered the poll anyway, 10% said, no, limiting my risk to 2 to 5% wouldn't affect my trading. Okay, that's fine. What do the majority say? 25% say, yeah, you know what? I may have lost last year, but I would have won if I'd have done what you just showed. You know, I'm sorry, I may have lost last year. Sorry about that. May have lost last year, but I would not have lost as much. Great. That's 25%. 45%, I skipped ahead, you know, with my eyes here. 45%, I lost last year, but I would have won if I had done that. Whoa. So this is a game changer. You would have won last year instead of losing last year if you had simply practiced the you know, keeping your troops under protection, right? Okay, and then 20% said I did well last year, but I would have done even better with this. So marvelous. Okay, so the first step is, you know, you take care of your losses and your wins will take care of themselves. A wise general makes himself almost impossible to attack. That's your Mary put position with all of your capital under a protective shield where you have 5 to 6% losses max, and if you get out early, it's going to be more like 2% or 3% maximum loss. Okay? All right, next. Move not unless you see an advantage. Use your troops not unless there's something to be gained. Fight not unless the position is critical. You know, using the income methods, there's 12 different income methods. If you use them as your crack troops to take advantage of the changing landscape of the markets, you can be real flexible and respond to what the market is giving you. Some of these income methods do well when the market is heading sideways. Some of them do better when the market is heading up, and some do well when the market is going down. And many of the income methods can actually be applied after the market makes a move. After the market makes a move. Can you imagine? I mean, usually when we're doing a play, we're thinking about what may happen, what we believe is going to happen, what our expectation is. But wouldn't it be great to make decisions based on something that's already happened, where you already have all the information at your disposal, everything that you need to know, right? That's what's kind of cool about the radioactive trading decision grid. Okay? Finally, do not repeat the tactics that have gained you one victory, but let your methods be regulated by the infinite variety of circumstances. Can lots of things happen? You betcha. Sure they can. That's why we have 12 income methods. Today I showed you one of the crack teams that we might send into the fray, because right now in today's market, right this second, income method number 5, the ratio call spread in context of the married put, makes the most sense to deploy with the Nike play. All right, but there are 12 different income methods for different battle conditions, right? And so we've got plays that work best in a volatile market. We got others that work better for downward moving or upward moving, quiet markets, flat markets. We've got all kinds of different arrows in our quiver. Wouldn't it be wonderful to be able to do something other than just sell a covered call? Wouldn't that be cool? Now, to learn all 12, you'll want to pick up a copy of the blueprint, all right? And I'm going to go ahead and hook you up here. This special extension here, /Iridium. This will get you the best offer that's available for the blueprint today. It's not what the what everybody sees when they go to RadioActiveTrading.com and they hit the products tab. Okay, this is special benefits, special extra added stuff that comes along with your blueprint. Okay, all right, good. Now we've got piles of questions, so let me go ahead and answer. Larry says, how would we do this without owning any stock at all? Well, Larry, you could do this by buying a call, and then you'd have to have a very good trading clearance, a very high trading clearance, and you'd need it because you'll be risking quite a bit more. You can buy a long call, but you'll be risking 100%. Okay. What my method does is that it actually automates your position sizing. It automatically makes it so that you can't overtrade the position. Okay, and so I discourage folks from doing this without owning any stock at all. And guess what? Some of the income methods you can't do unless you own stock. But you can do something similar if you wanted to risk too much. You could do that. Let's see. Robbie says, could you just sell 2 calls against the long stock and simply close a trade once the stock gets to the maximum profit point? Dangerous, Robbie, because having 2 short calls against 100 shares of stock is what they call naked. Okay, you'd have 100 shares covering one of the calls. That's why they call it a covered call, right? And then the other call would be naked. And an overnight gap, for example, could hurt you really badly. Okay. Which income method is this? Asked Ed. Ed, it's income method 5. And of the 12 income methods, this is one of the 3 that can pay you twice. You get paid on the entry and then get paid again as you exit. Kind of interesting. Okay, cool. Other questions, guys? We've got 15 minutes left here. I don't have any problem closing up early. You're welcome. I don't have any problem closing up early, but I can stick around and answer questions up till 11 o'clock if you like. Real quick, I'm going to jump out of here, and there's my thanks for coming. And the class just went a lot faster than I thought it would, which is a happy thing, right? You know what? I didn't do all of my polls, so let me do this. We just asked this one, okay? Would you have been better off if you'd have traded my way last year, okay? And 10% of the folks that answered the poll said, well, no. But the other 90% said, yeah, that would have done better. All right, cool. How much better? Let me ask. How much better? And for those of you that think, you wouldn't have done better, go ahead and tell me. Okay, say same. But would you have saved or made enough to be ahead by, say, $50 a month? Would you be ahead by $1,500 or more, or would you be ahead by maybe $5,000? Difference if you had protected your downside and also used short-term plays to capture income. By the way, this play captures quite a bit more income than a covered call would. I'm going to go ahead and show that to you. I'll show you the difference here in just a moment. Okay, more questions came in. Do you time your buying of the stock? Asked Chris. Yeah, but the thing is, the way that I would time it and the way that you would time it and the way that Jerry and John and Susie would time it could be different. And actually, the radioactive way of trading doesn't actually take into consideration the timing. Here's what I mean. When you time your purchase, it's because you believe your stock is going to go up, or if you're shorting, it's because you believe that the stock is going to go down, right? That's your timing. But the overlay onto the purchase or the short, the overlay is the radioactive trading 5-line setup. The overlay is what ensures that you won't lose more than 2 to 5% of your capital. Kind of cool. Can you use leaps in place of stock? Asked Lauren. Lauren, same question that was asked earlier by, I think it was Robbie? By Robbie. Okay, all right, hang on. I got to close my poll here. Now, how did I do that? What just happened? Is the poll still showing everybody? Is the poll still showing there, folks? I need to know. The poll is still showing. Okay. Well, this is wonderful because I'm doing my very best to close the poll, but I can't seem to find it. That's something else. Okay. All right. Let's see. Ah, there we are. Okay, all right, good. So let me close the poll. I'll share the results with everybody. Okay, so I guess the few that said, well, that wouldn't have helped me, that they sat this one out. Okay, but so here's what you told me. 18% of you said I would have saved or made enough to be ahead by $50 a month. Guess what? That's $600 in the last year. And by the way, if I ask you the same question next year, will you have the same answer? You know, I hope that you would say, no, I did it. I hope that you would say, nope, you know, I did stay out of trouble. I never had a loss greater than 5% of the capital I had in that trade. Okay. Let's see, another 18%. Oh, and by the way, $50 a month times 12, that's $600. That's how much the home study kit, our highest price product, costs. Okay. 18%, I'd be ahead by $1,500 or more. Oh, okay. So you could get the home study kit, $600 for yourself. Plus, you could also get a year of fusion and look over the shoulders of other radioactive traders as they trade the markets live and outperform the S&P as they have. Okay, and then 64% said this would have made at least a $5,000 difference last year. So you could get the blueprint is actually a lesser cost version. It's $339. All right, you can buy the blueprint for yourself and 16 of your best friends. So how about that, right? Okay, let me go ahead and close that. And we got more questions coming in. I'm going to do another question here for you guys while I'm responding to yours. Okay, what do you think of the income method that I showed you? Okay, what do you think of the income method that I showed you? And by the way, that income method, here in a moment, I'll demonstrate how much it outperforms a covered call. Okay, so Gene says, married put, at the money or in the money? And if in the money, by how much? Gene, great question. You buy that put in the money and far away in time. There is an exception to that rule. I'll give you the exception in just a moment, okay? But normally it's in the money and far away in time. And here's why. When you buy it far away in time, your time decay happens very slowly at first. And so if you have an out of the money put, that slow decay doesn't hurt you by very much, all right? But the stock going down does. Okay, but if you have an in the money put, that slow decay doesn't hurt you very much. And for every dollar that your stock goes down, your in the money put goes up $1. For every dollar it goes down, your in the money put goes up $1. So there's no loss there. All right, so buying in the money far away in time is a really, really good way to skew what your stock can do. All right. Great question. Oh, and by how much? In such a way, Gene, that you're not risking more than about 5 to 6% of your capital. Okay. John asks, you can still lose the amount of your stock price if Nike drops to $30 a share. You lose $3,000. No, you weren't paying attention, John. That's not so. Let's go ahead and take a look at that. Okay. I'll close this poll so that we can look at that. Okay, so John says you can still lose the amount of your stock price. Okay, let's see if he's right. $3,000, he says. And I'm not trying to pick on you there, buddy. We just got to investigate the truth of what you're saying. Okay, so we've got our shares of Nike, right? And we've got our put option in place protecting us, and we've collected a little bit of stuff here. And if the stock goes down to $30 a share, the contention is we're going to lose $30 times 100, we're going to lose $3,000. Let's see how much we actually lose. 695. That's the worst case scenario here. Oh, and that's with 200 shares. Let's change this back to the 100 shares and compare apples with apples. All right, let's do that. I should have fixed that already. I'll say, man, really? That seems high. All right, so so this is how much we'll lose if the stock cuts in half, John. We're going to lose $337. And the reason that it's not more is because of doing this ratio call spread. Let's take out the ratio call spread. Let's just go to the pure setup of buying the stock plus the put option that's far away in time. And then let's go to January, or not January, what is it? March expiration. When was March expiration? I'll just say end of March. Let's just say there. And $30 a share. Now the contention is you're going to lose $3,000. No, you're not. You're going to lose about 358. Okay, there's still going to be time left to expiration. So getting out early will make you more money on the way up, and it'll lose you less money on the way down. If your stock is down to $30 a share, guess what? You can get out and not get hurt that badly. Okay, kind of cool. All right. Other questions? Let me go ahead and see them. Whoops. Got hands raised. And question. There we go. Come on, questions. By the way, I do own the blueprint. I just didn't understand it before. Oh, Ed, I'm glad that you purchased the blueprint. And tell you what, if there's ever any concept that you don't get, write in to support at radioactivetrade.com. The blueprint is not a just simply a book of pages and ink. It's the support of 2 offices. Okay, you've got Power Options in Delaware on the East Coast. You've got Radioactive Education here in Colorado. And if you pose a question about anything in the blueprint, either I will answer or one of the staff over at Power Options will answer. If you're a Power Options subscriber, of course they'll answer. Okay. Okay. Chris says, when a stock falls heavily overnight like Bear Stearns, would the puts capture all the fall? Yes. That's what's kind of cool about this. Is that your put options go up in value. They capture and keep you out of trouble. Do you do the ratio call spreads every week? Asked John. No, we respond to the market and which of the 12 income methods makes the most sense in light of, number one, what the market is, and in light of, number two, what our goals are. For example, if your goals are more about growth, you might choose income methods number 5 or 8 or 11. If your goal is more about income, you might want income method number 3 or 12 or 1. Okay, and so do you do call ratio spreads every week? You could apply income methods each week. Okay, but it depends on what the market is giving you. Great question. If you took this Nike position, would you do the call ratio spread every week? No, because generally speaking, a call ratio spread doesn't happen every week. Now, is an income method available each week? Yeah. Yeah, an income method is almost always available. But it probably wouldn't be the one that I showed you. That's why you got to get the book, John. Oh, okay. Guys, I'm going to share the poll. The 38% of you said that was wild. I didn't know you could do a riskless spread trade. 63% said this one trade made it worth all the time I spent here today. And this adds up to more than 100% because you could vote more than one category. So 25% say, I want to know more about riskless spreads like this. Great. You want to go to radioactivetrade.com/iridium to pick up the blueprint. 25% say, can I do what you just showed in an IRA? That does depend on your custodian. You could do this exactly what I showed in Thinkorswim or Interactive Brokers, or any number of the better, more flexible brokers. Some folks are a little stodgy, and you're going to have to explain to them, hey, guess what? When I sell 2 calls, but I also own 100 shares of stock and I own a call, I don't have anything uncovered. It's okay. You may have to explain it to your broker, and your broker may still not understand it. And I'm serious about this. Okay, there are folks out there that pass the Series 6 that don't understand anything about options trading. Let's see. John wants to know, are the best trades few and far between and hard to find? Well, John, that's why I use Power Options. Now, I'll go ahead and do this real quick. That's a great question. John is our most active question answer. We got piles and piles of folks asking questions. But what I'm going to do here, folks, is go ahead and answer that question how I do it. Okay, I'm going to show you how I do it, how I find these trades, and do it in seconds. Okay, and let me give you, this is our final poll. This is it. Okay, no more polls, but I'm going to put that poll up while I pull up the screen and plug in the kind of the answer to the question. Okay, so gotta get over here to Power Options and Mary put play. Okay, I'll leave that pull up for just a few more seconds because it's more of a sales tactic than a poll, isn't it? That's pretty transparent. I'd like to know what your objection is, though. Okay. So folks are still answering the poll, and I appreciate it. Let me go ahead and close it, okay? I'm going to close it right now. Okay, so 30% think it's pricey at $600. Well, you must not be the 30% that told me this would have saved me $50 a month last year, because that's 600 bucks, right? And if you plan to trade for more than another year, duh, it should pay for itself. Now, of course, the folks that said, hey, $1,500 last year would have saved me. Of course, you understand the value, and the folks that said $5,000 last year, of course, you understand the value. All right, now 20% say I'm scared of getting my hopes up again and not delivered. I understand. Did compound stock earnings offer you a 100% refund? No, but we do, and we have ever since I began offering the blueprint. And we used to only have 4 income methods. That was back in 2003. We had 4 income methods. 2002, I began blogging about the radioactive trading income method. I began getting asked, hey, would you write a book? I actually pre-sold the book. We had thousands of dollars in sales of the blueprint. And back then, I was only charging $189. We had thousands of dollars in sales before I wrote it. I gave everybody the table of contents. I said, look, this is what it's going to cover. If enough people order it, I will write it. And if you don't, I will refund your money. And I put up a cheap little PayPal switch there. And guess what? After seeing me trade, after looking over my shoulder and seeing me trade, folks said, you know what, let's do this. And so if you're scared of getting your hopes up, guess what? I understand, and for that reason, I've always offered 100% money back refund, even before I wrote the book. Okay, and then 50% say I've been waiting for a sale. Don't wait, because we've done nothing but raise the price. And there was one exception. One time in 2007, one time on my birthday, I gave it away for $100. Okay, at the time we were charging $189. And I gave away copies at $100, and the floodgates opened. And guess what? We had so many people pick up the blueprint that we weren't able to meet our own standards of support. And so we don't do it anymore. We just, look, if you're serious about trading, get the blueprint. If you're worried about getting your hopes up, there's a 100% money back guarantee. If you're waiting for a sale, don't do it. Don't do it, because now the blueprint is $339. And the upgraded version, the home study kit, is $600, and it's because we've added value to it. We've got 12 more income methods. There are less people in the world that are qualified to answer all the questions that you're going to have. Okay, but you have the support, and that's paid for. It's paid for in advance by your purchase. Okay, so all right, good. More questions came in. I'm already an owner of the blueprint, and I love it. Thank you, Chris. I already have the blueprint, says Jim. Awesome. Sorry for joining the webinar late, says Clement. Hi, Clement. Yes, there is a recording. I'm recording this, and I'm getting ready to finish it. Okay, so John, I'm going to answer John's question, and then we'll go ahead and close her up because we're at the top of the hour. John asked, how do you find these kinds of trades? Okay, well, here is the Power Options platform that I use. By the way, they sell my book. Hey, look at that. And you know what? The guys in the office, you know what they do? Even though they have 23 options trading strategies that they support, like double diagonals and iron condors and bear call spreads, you name it, calendar calls, the guys in the office trade my method because it's what performs. Since 2007, the guys in the office have been doing it, or 2008, sorry. And in fact, in 2008, one of the guys in the office at Power Options, I know this for a fact because he told me, he had a 0.6% loss in his portfolio in 2008. Long stock the entire year. Okay, so he owns stock the whole year, right? Trades my way. He moves everything out of, condors and butterflies and all that nonsense, and he gets into trading radioactively. 2008, the bottom falls out of the market, and he loses 0.6% of his capital. You know what that means? That means he had 99.4% of his capital left when he was buying stock in March 2009, the bottom of the market. Kind of cool, guys. Okay, so here's the deal. I just go to search on the Mary Put tool. You know what's already input? What's already input is is the radioactive trading standard of trades defined. So here's 1, 2, 3, 4, 5, 6, 7 plays that are available right now. And if you want more information, you just hit that. If you want a chart, okay, you can look at the chart. If you want the setup right now and taking it over into the what do you call the custom spread tool, you can do that. You can look at an income method. Hey, what if we did income method 5? I don't know if 5 makes sense, but let's find out if it does. I don't know if 5 is going to make sense. We got a $75 put. Buy 1 call and selling 2 against. Oh, it doesn't make sense. Well, it might. It might. If you get filled, let's buy, buy 1 of those and sell 2 of those. Now, here's the deal. You have to do limit orders with this to try and get filled at a credit. This isn't filled at a credit, okay? So we don't like it, okay? But if you were able to, say, shave a dime off of that, and you were able, say, to get a dime there, then boom. Now we've got a credit that you're making. Okay, and that's a much better scenario. I still don't like it because you've still got another way to lose. Even though it's like 8 points away, it's still, you know, I don't know. I might not do a method 5. I might choose something else for this. I might do a method 11. It's probably a better one. Okay. Oh, oh gosh. Somebody says, I can't see what you're doing. The poll's still up. Okay, sorry about that, guys. Sorry. We got like 7 of you. I can't see it. Okay, good. So that's actually, when you heard me narrating, that's how fast I'm able to pick and then evaluate a not just a radioactive profit trade, radioactive profit machine trade, right? The stock plus the put, but then also I evaluated one of the income methods, and I did it that fast. Okay, so great stuff. Okay, sorry, but I missed the answer to my leaps question. Lauren, the answer was don't do it. The answer was, it was the same answer that I gave to the other fellow. It says, could you do this with just options? I said, well, yeah, you could, but you'd be risking a lot, or you'd have to be thinking through your position sizing. Here, the position sizing is automated. Okay. How many trades a month do you take on average? You're welcome, Lauren. John says, how many trades a month do you take on average? Oh, I don't know, 7 or 8. Kind of depends. Ernie, John says, Ernie did Ozark back on November 11th, 2015. He bought 100 shares at an effective cost of $54.04. And he bought the May $55 put option. Ozark is down a lot since then. Any ideas on this besides income method 9? Well, income method 9 comes to mind, John. At the very least, we know that Ernie isn't going to get hurt too badly, right? He can't get hurt too badly because he has that put in place. And if he didn't have the put in place, it would have been, could have been bad. Where is Ozark? I don't even know. What was this? Ozark and a May 55 put? Okay, hang on. Let's just take a look at that. Sorry, guys. I want to handle everybody's questions. And this wasn't my trade, so I really don't know where things are. Okay, so it was 54.04, you say. Okay, 54.04. And you also got a what? A May? Here, I got to toggle back and forth between this. May 55 for 440. Okay. All right, so here's what we're going to do. We're just going to do today's liquidation price. Today is what? It's the 26th. Let's just grab, or 27th. Okay, today's the 26th, but we're grabbing the price for the 27th. And let's say it just stays at the price that it is. What is our loss going to be? $283. Okay, $283. Now, that looks like it's going to be a loss, you know, unless Ernie does income method number 9, which uh, would roll down his put, right? If he does income method number 9, he could take some money on that put, but he will also open up his risk. So 283 is what he has lost. What would happen if he had not done the put? 5404 was the price of the stock, and now it's 4189. So the losses would be quite a bit more than 283. Do you see that? So I think him liquidating right now might be the thing to do. But I'm not Ernie. I don't know what he's going to do. So that's a good question. Now, this is a question to somebody that is John is a Fusion subscriber, so he's looking over the shoulder of some of our radioactive traders. And our radioactive traders are doing well, all right? But not every trade does well, does it? And so he's asking about a losing trade. I like to brag about my losers. Okay, you know why I'm bragging about this loser? Here's a fellow that for every 100 shares, he normally would be losing 1,200 and change, right? But instead, he has lost 283 if he gets out today. Okay, and yeah, definitely shows the value of Mary Put, says John. That's right. Why did he not do a call ratio spread also, says John. Uh, Actually, John, I don't even know what else he's into, what other income methods he has or has not done. So I'm just showing that setup. Okay. All right. Very good. Okay. So we got different Johns, by the way. There's John S, and there's John D, and another John earlier. Okay, folks, it's a little past the hour now, and thank you for sticking around and asking all those questions. If you want to pick up the blueprint, it's available here at radioactivetrade.com/iridium with 5 special bonuses. I do urge you to consider that, especially since most of you told me that if you had only known what I showed you in the free webinar, you would have saved $600 last year. Well, the home study kit is $600. The blueprint is only $339, and they both come with a 100% money-back guarantee. Oh, what is the difference? Okay, the difference between the home study kit and the blueprint, the home study kit simply adds to the blueprint with 6 audiovisual CDs that are recordings of webinars where I've taught all 12 income methods. Okay, so if you just like pages and ink, get the blueprint. If you like pages and ink and you like to hear my sultry, silky voice, then and see animated versions of stuff while I'm speaking you through it, then that would be the thing to do. Okay. Oh, other questions. Sorry. Thanks. Fun today. I did an RPM on PFE. Is that Pfizer? Okay, so John just picked up Pfizer. Good. If you are a blueprint owner and you want to add the study kit, can you just pay the difference in price? Yes. If you happen to already own the blueprint, write to support at radioactivetrading.com and somebody will get back to you. It's a $260 difference in price. If you bought those CDs separately, it'd be like 540 something. I think it's 546 or whatever 89 times 6 is. They're $89 a piece, but it's $260 for all 6. I had to step away, asked Robbie. Did you answer my question? I have the blueprint, but I only have income methods 1 through 10. Should I call to follow up? Robbie, you got an earlier version of the blueprint, and you have 2 choices. One is if you want a hard copy of the blueprint, you just pay $39 instead of $339. It's only $39 to get a new copy that's completely updated. Your other option is a free option, and that is, look, since you own the blueprint, we have you on record as an owner. Log into your account there at radioactivetrading.com, and you can download PDFs of income method 11 and 12, and there's also some videos for blueprint owners only on income method number 11, I believe, and definitely 12. There are some blueprint owner only videos, just some added value stuff. A lot of times blueprint owners don't log into their section and see the value added stuff, but we add stuff all the time. Okay, you're welcome. Very good, Robbie. Okay. All right, folks, I'm going to go ahead and close her up then. Thanks for all the questions. Thanks for sticking around, and we'll see you out there. Happy trading, and bye for now.